Good morning once again, and welcome once again back to the Barron's 30th Annual Investment Conference. We're so excited to have you here. I hope it's going to be a great conference. There's probably not a topic that's more timely than what we're going to talk about this morning, and we're going to switch gears completely from the first two panels. We're going to go into the international and emerging markets. The theme of this year's conference is Own It, and I think maybe after some comments you're going to get a little feeling on whether it's time to own it in the international and emerging markets. My name's Frank Maiorano, and I'm the head of the Registered Investment Advisor, Family Office, and Bank Trust business at Barron Capital. And I'm joined here by my esteemed colleagues on the portfolio management side who share over 50 years experience on the investment side. So just like we did earlier, or just like the other panels have done, we have mic runners in the audience, so please raise your hand, and we're going to take questions. But I want to go ahead and have our PMs introduce themselves, the funds that they manage, and then we'll start off a question, and then we'll go to the audience. Michael?
Thank you. Thanks, Frank. Michael Kass. I've been at the firm over 15 years. I manage the Barron Emerging Markets Fund. Anuj is the assistant portfolio manager of that fund, and I manage the Barron International Growth Fund and co-manage the Barron New Asia Fund.
Hi, Anuj Aggarwal. I've been at Barron for about 11 to 12 years. Assistant portfolio manager on the Barron Emerging Markets strategy, as well as co-portfolio manager on the recently launched Barron New Asia Fund.
Perfect, perfect. Michael, if you could kick it off by maybe sharing your outlook on emerging markets. It's been a tough, everything ex-U.S. has been a little bit challenged over the last couple of years, and I know people are wondering, you know, when is it time, and is it time to be opportunistic? So maybe shed some light on that.
Definitely. Both emerging markets and international, equities have definitely underperformed, and we do think that it presents, really attractive opportunity right now, particularly on a relative basis. First, I think I want to start by just highlighting the historic relative valuation discount. I mean, that's telling you, I think we're at somewhere near 30-year lows on a relative basis in terms of, looking at ex-U.S. equities relative to U.S. That's telling you there are a lot of concerns or risks that have already been considered and have been largely discounted. And so again, it's important, to not only think about the direction of fundamentals, but also what has been priced in, and we think that presents opportunity, particularly on a longer-term basis. Second, I think we have to look at the U.S. dollar, because even though, here at Barron, we're really not focused on macro, we're bottom-up fundamental stock pickers. There's just no denying the correlation between, say, relative performance of ex-U.S. equities and the U.S. dollar bear or bull or bear market cycle. Now, we are now 14 years into what is typically a 10 or 12-year dollar bull market. The dollar has appreciated from trough to peak about 65%. The peak was actually last fall at about this time, and I know I talked about similar comments to what I'm saying today. I think what's interesting is that even though, the driver of that strong dollar, a lot of it has to do with, fear of Fed hiking, interest rates going higher, inflation, remaining high, which will prompt further hiking. It's interesting that this year, while the Fed terminal rate, expectation has moved up another 50 basis points or more, and more recently on the long end of bond yields, those have risen another 100 basis points this year from previous expectations. The dollar is still well below where it was at this time last fall when it was making its peak. And so to us, that's presaging coming weakness in the dollar, and is kind of a signal that we should be thinking about reallocating away from U.S. equities towards international. What's going to be, I'd say, longer term, the bigger surprise, obviously the dollar is going to be important, it always is, but the bigger issue and the bigger surprise is going to be what we think is really improving relative earnings potential on non-U.S. equities. The drivers of that are deglobalization. I think, we'll probably talk about that when we get to Q&A, but in our view, deglobalization is really favoring relative earnings growth on non-U.S. because we think those economies and those indices are more closely geared or aligned with the capital spending that's going to be required in a deglobalizing world. The dollar bear market, again, and just the way that works in terms of driving earnings, the way that translates into earnings potential is that, when you have trillions of dollars coming out of international assets and moving into U.S. assets over a 12, 14-year period, think of that as that 65% rise in the dollar is a 4% per annum tax on having any assets, if you're a U.S. investor, allocated in non-U.S. You're kind of giving away 4% off the top on dollar on currency devaluation in foreign currencies. When that cycle reverses, that becomes a yield enhancement, and then you will see a wall of capital returning to those international assets. And what that does is it puts downward pressure on interest rates and upward pressure on currencies in those jurisdictions, and that's very stimulative to domestic growth, consumption, investment in those countries. And so it's the mirror image of the headwinds we've been working against for the last decade or more. And when that cycle turns, we think that that's going to unleash unexpected earnings power in ex-US economies, companies. A third factor that we talk about a lot is the emergence of India, which is now become the largest weight. I think mark to market this quarter, it's the largest single weight within the emerging market portfolio. It's a large overweight in the international growth portfolio as well. But India is going to be I would say the highest growth major economy in the world, and from a geopolitical position, we only see strength on strength here. They're going to be one of the key beneficiaries of the evolving geopolitical environment. And so, now that, if several years ago, and I think Anuj will talk more on India, but, it's gone from being somewhere mid-high single-digit % of an EM index. Now it's up around 15, 16%. It's near close to 30% of our portfolio. But that's becoming big enough to become, important factor in terms of looking at the earnings power and earnings potential. And we think ultimately in the long term, India may well become the largest component of an EM index down the road, several years down the road. And last is, China itself. No question it's slowing down. But within China, there is major pivot going on towards, value-added industries. And I think just to sort of highlight how this can translate into earnings power, perceived earnings potential for the EM asset class. Just think about the auto sector. For the last 15 years, German or U.S. companies have dominated profit share within the Chinese economy in terms of the auto sector. That was the ICE world. That was the, gasoline-powered, auto world. As we're transitioning to EV, and China is ahead of the rest of the world in that transition, it is local domestic OEMs that are capturing the most share and really changing the dynamics of that market. And they're actually on the verge of breaking out and beginning to capture global market share. We think most likely the Chinese auto sector is going to be the largest global market share gainer in the world in this transition to EV. And so if you think about that and multiply that across a number of other industries, whether that be pharmaceuticals, automation, high-end consumer goods, precision manufacturing, this is happening, biotech, this is happening across, I'd say, this is China's side of deglobalization, is favoring, pivoting towards emerging leaders in industries that have previously been dominated by Western multinationals within China. And so we think that is kind of a vector change that's going to help perceived earnings power for EM looking forward. So, summing it up, we see a potential paradigm shift in terms, and that's going to be the big surprise, and that will, we think, support relative outperformance from current valuations. Again, what's priced in is really important. But the question, I guess, is what's the catalyst? What's going to trigger this inflection point? I mean, we believe that a slowing global and U.S. economy with, inflation expectations coming down, interest rates coming down, can be a trigger of the beginning of this reversal of mean reversion of relative performance. We think that EM or international can outperform in a global correction, not necessarily generating absolute returns if we have to go into a global slowdown, but they will likely go down substantially less. Why? Because those economies are already, there are low expectations. We're already pricing in some form of slowdown or even recession in different pockets of our universe. That is not true here in the U.S. And those central banks are already at the beginning stages of an easing cycle. We know that the Fed is going to pause in the U.S. for an extended period, which in our view is going to kind of present a vacuum of earnings visibility for U.S. and global-facing companies. But that, the Fed kind of dragging their heels on an easing cycle is all we need for these international central banks to begin a more powerful easing cycle. There is no inflation problem in our economies, in our jurisdictions. There is a risk of deflation coming in some of our jurisdictions. So we think that once it's clear the Fed is done, counterintuitively, we're going to begin this rotation of relative performance. So I'll leave it at that. I mean, the last thing I want to say is at some point in coming years, we're going to see an end to the, we're likely to see some resolution of the Russia-Ukraine war. And however that is resolved, that we think that will also be a catalyst to drive investors back into ex-U.S. and into international and EM. They've been punished because of, from the beginning of that conflict.
Perfect. Thank you. So our mic runners are out there. Raise your questions, and we'll go to the answer right over here.
I'm a big fan of Warren Buffett, so I want to ask Michael why he disagrees with Mr. Buffett on Taiwan Semiconductor. And then number two, does Michael agree with Mr. Buffett about investment opportunities in Japan?
Okay, so I wouldn't say I necessarily disagree with him. We were significantly underweight Taiwan Semiconductor through last year, but in the 2022 sell-off, we felt that, again, it had gotten to a valuation level at the trough of its historic level. It's a great company. It is one of the world's, leading, most dominant, companies in one of the most important industries in the world. They dominate the leading edge. They are a huge beneficiary of AI. And so, from a bottom-up fundamental, and that's what we do, from a bottom-up perspective, that is still a very exciting investable opportunity. We want to be careful about, market valuation from time to time, and it's a cyclical industry. But, I would say it remains a very high-quality business. What we're going to be watching in the future, picking up on my previous comments, semiconductor industry is one of the places that China wants to invest heavily and build up capacity. They're not going to be able to compete at this leading edge, high end, where Taiwan Semi dominates. But we do think that they will materially expand capacity at, at the higher nodes, at 28, 45 nanometer nodes. And we think that will have an impact on pricing power and margins across the global semiconductor industry as, to the extent China can penetrate those markets. So that's something we're keeping an eye on. They're years away from that, but I would say for now we're comfortable. On Japan, we completely agree. We've been adding to Japan in the international growth strategy. Japan is, like India, one of the key beneficiaries of the geopolitical shifts that are occurring. We're seeing a lot of foreign direct investment going into Japan after years of sort of deflation and I would say currency depreciation. The labor market, particularly on a productivity-adjusted basis in Japan, is incredibly attractive. And from a geopolitical perspective, it's very safe. So you have multinational companies around the world with 85% of their supply chain or manufacturing base in China looking for a place to diversify. In the developed world, Japan is one of the great beneficiaries of that. And so we're seeing that benefit. And they've also, I would say there is a renaissance of shareholder of activism, of corporate governance, of, I would say maximizing returns on investment, which is really kind of a new religion within Japan that we really are just seeing emerge. So there's a lot of important long-term fundamental reasons to be optimistic on Japan, and we plan to continue to increase our weighting and our investments there.
Anuj, Michael mentioned India a few times. You're an expert on India. It's been the bright spot in the emerging markets. I know it's the largest absolute and relative weighting in both the New Asia Fund and emerging markets. Can you give your kind of overview of India and maybe even mention a couple of companies that you like particular?
Yeah, sure. As Michael mentioned, I think India is probably the most exciting investment jurisdiction within EM, and I would say probably the world. I think it probably comes as a surprise to the audience that India has been the best performing large market from a stock perspective over the last 3 years, even trumping the S&P in US dollars, as well as over the last 20 years. So if you invested in India in 2003, you made 7.7 times your money in US dollars versus the US at 6.2 times. So that's probably a big surprise where you've got hidden jewels ex-US, which are actually doing better than domestic markets out here. India is, in our view, India is positioned to be the fastest growing large economy in the world this decade. We anticipate GDP to grow anywhere between 6 to 8%, over the next 3, 5, 7 years, and I'll get into more details on why that's playing out. But that is really driving a lot of bottoms-up investment opportunities for us as well. So just to give you the lay of the land, just a few numbers out here again. India was the 10th largest economy in the world 10 years ago. It's now the 5th largest, and we believe, and as per the IMF too, that it's going to be the 3rd largest economy by 2030, trumping Germany and Japan as well. So that creates a lot of exciting opportunities for us as investors. Really think of India as the new China. What played out, the growth miracle that, investors have seen in China directly or indirectly over the last 30, 40 years, India is just beginning their journey. So that's one of the reasons why we've made India, our largest absolute weight, as we speak. That's where we see the opportunity. And I would also say what's transpired over the last 2 years has been advantage India from a geopolitical standpoint. India has increasingly strengthened its ties from a military standpoint as well as from an economic standpoint to the U.S. and the West. India's largest trading partner is now the U.S. It was first China, and over the last couple of years, it's now the U.S. So clearly, the direction of travel is increasingly more aligning with the principles of the West from a geopolitical economic standpoint, which also gives us comfort as investors. I'm sure a lot of you probably have that same feeling of knowing that your capital, or a large part of your capital, is being invested in the largest democracy in the world that's aligning to the West. In terms of where we're seeing the opportunity sets and why we are really excited about India, it's really because of the productivity-enhancing economic reforms that have been implemented by the government over the past 3 to 5 years. And that's really transforming the economy. And I'll mention a few things without getting into too much detail. But the implementation of one of the most transformative tax reforms called the GST, which is the Goods and Services Tax, has really accelerated the formalization of the economy while also increasing tax yield. So just to give you an example out here, tax collections, because of this legislation, have increased 30% from pre-COVID levels, while the GDP is just about getting to just about pre-COVID levels. So that's really exciting because what that formalization is doing is it advantages well-managed, branded, organized players that are publicly listed companies that we are invested in. So companies like Tata Consumer, Jubilant FoodWorks, Trent Industries, these are portfolio companies that have immensely benefited from market share gains as the economy formalizes and lower quality, unorganized players basically get out of the system or lose market share. So that's really exciting. The other real structural driver of GDP growth, as well as from a bottoms-up stock selection for us, is going to be what's happening in digitization. India's digital ecosystem is just inflecting. Think about India's ecosystem as maybe 15 to 20 years behind that of China, and the value creation that investors have seen over the last 20 years, investing in various tech companies in China. Granted, the last couple of years have been tough in China. We are just getting started in India. So what we are doing as bottoms-up investors is really identifying the dominant franchises in each sub-tech vertical, whether it's e-commerce, fintech, food tech. We've got probably 15, 20 years of growth that lies ahead. So, that's where we're spending a lot of time. There are other great bottoms-up themes, opportunities. One is the supply chain diversification theme. If you're a US or Western corporate today, say if you had 80 to 90% of your manufacturing footprint in China, your board of directors is, giving you a wake-up call that it's time to think about diversification into other countries or get back business to the US. So this is going to be a big opportunity for a country like India, along with Southeast Asia, Mexico, where we are seeing significant foreign direct investment come into the country. And the numbers are pretty staggering out here. India's FDI was about 60 billion in 2019, pre-COVID, and right now it's 180 billion plus and growing. So you've seen a 3x ramp in committed foreign capital that wants to come into India. That will come over the next 3-4 years. So that's really exciting. So in a nutshell, it's going to be the fastest growing economy in the world. And due to the economic reforms and digitization and the geopolitical vector changes that are playing out, we believe there's significant value creation for bottoms-up investors like us taking a long-term approach.
Thank you very much. I think there might be a question over here.
Good morning. 2 questions, one for Michael, one for Anuj. One for Michael would be, you've been a great risk manager over the past many years, and the team has done a great job. I'm curious how you think about risk management in the current environment. And for Anuj, I echo your enthusiasm for India, but I'm curious how you balance the rest of Asia and the New Asia Fund. Thank you.
Great. So, risk management as a long-term bottom-up investor, there are, limited tools, but we certainly, think about that all the time, and that's really, how we're wired. I think, let me just put it in these terms. I think that in the last couple of years or so, the geopolitical, catalyst has emerged, I think, as a dominant driver of really defining a risk premium, I would say. And that's a change from maybe the prior period, before it really, I would say it's Russia invasion of Ukraine was kind of the watershed event. And I think that, as I said earlier, and I think on the first panel, I remember, there was a discussion about extremes and how, U.S. growth stocks were at extreme valuations at the peaks in, 2021, early 2022, and maybe they should have done something. Maybe people, even long-term investors at a moment like that should be thinking about managing the risk of having those, carrying those extreme expectations and valuations. I would almost say that our asset class, it's turned upside down, and we've had a big widening of risk premium. It gets back to what I said about those valuations. There's a lot of concern. I mean, China itself probably has some of the most substantial risk premium, out there in the world today. A lot of that for good reason, but a lot of that, is priced in. And so, I think that that's what I would want to convey is that I always talk about with the team, and when we're looking at whether it's an individual stock and at the asset class itself or certain theme allocations, what's important is not just what are the risks, but what has been priced in. And I think at this point there is, very substantial pessimism priced in. I would imagine most people in this audience don't have a lot of EM or international exposure, or they have less than they had at whatever the peak was, and that's just kind of a barometer of where we are. And so I think it's time to start to think more contrarian.
Just to answer your question, we do see a lot of exciting opportunities ex-India as well. And while we may run New Asia and the EM strategy with a larger India overweight, we have several themes across EM in Asia that we invest in. And I think Michael had briefly mentioned that, just look at the China value-added theme. We've got a lot of investments also in China, which will disproportionately benefit from these geopolitical events that are playing out. As China is striving more for technology self-sufficiency and creating their own emerging local national champions, it's going to be advantage these Chinese domiciled countries. It's not going to be the Volkswagens of the world or some other MNCs that operate in China, given what's playing out with geopolitics and protectionism everywhere. And so that's what we are trying to do from a risk management standpoint, as well as from a bottoms-up growth standpoint. Where do we see the best opportunities? So given the situation is so dynamic, given geopolitics and obviously the wars that are playing out, and increasingly we're getting to a deglobalized world, that's what we're trying to do. Just think about the businesses from a bottoms-up standpoint, because that's what we do at Baron Capital. Invest in bottoms-up great businesses that have vector changes that will create significant upside for us. And so that's how we are thinking about our risk management as well as our bottoms-up frameworks. There are a bunch of other opportunities, whether it's AI-related businesses in Taiwan, EV battery manufacturers in Korea, shipbuilders is pretty exciting. If you think about what's transpiring with energy security, so there are pockets of pretty exciting opportunity ex-India as well. So that's how I would think about it.
Anuj, we got a streaming question that's just a one-word answer. Someone asked, what's the percentage of India in the emerging markets fund?
It's about 28%, 27, 28% in that range.
Okay, perfect.
The EM strategy.
Audience question over this way.
I want to follow up on your risk in China. Michael, you mentioned a couple sectors that are really looking good for China, but at the same time, the shrinking GDP there, the disappearance of a few more tech executives, the restriction on technology transfer that both the EU and the US are imposing, the risks involving Taiwan. You're saying these are all baked into your outlook, and is the long-term outlook really that positive?
What we're saying is that if you think about let's just focus on Taiwan for a minute. I think when you look at both Russia's experience in Ukraine, the fact that China is nowhere near technology, semiconductor self-sufficiency, we think that it is a very distant likelihood in terms of, China's calculus on whether they would do something with regard to Taiwan. We can't know that for sure, but we can sort of look at what's at stake and what the risks are. And so certainly there's no question that there is, the economy's been slow. We look at the kind of major signals of risk premium out there that are market related, whether that's the Chinese currency, whether that's credit default swaps, whether that's, bond spreads, domestic bond spreads. They're all well below previous peak levels and in previous sort of domestic, whether you call them crises or slowdowns or recessions, et cetera. And we believe that that signals to us that the Chinese authorities still have the potential to address the economic challenges. And we do not believe that there's going to be it's a very low likelihood in our view that something happens with regard to Taiwan, within our investable, within our framework. And so from that perspective, we believe that risks are fairly well discounted. It doesn't mean that that's going to, that there's not some risk that you get a tail case. But I would also say, we have been, if we were here a year ago and we were talking about zero COVID and talking about the likelihood that there were political and financial constraints and they would have to reopen, which then I'd say a week or two after the conference that did happen. There was a big rally in China that extended into the first quarter, and it's been, I'd say a disappointing recovery since. We think that they still have the tools, and they're still working on, I would say, driving an economic recovery. But I would say we're now in a framework of market weight being kind of our peak exposure in China, and we expect that to be somewhere between, underweight to market weight. So I appreciate, I would say, enthusiasm for investing in China, which was a big driver of alpha for us over the last decade, has clearly given way to more enthusiasm on India. We think that the risk reward presented to us from a bottom-up perspective in China is attractive now, but the long term, I would agree with you, it's less. There's less confidence that what returns that we've been able to generate in the past over the long term are going to be available in the next, say, decade plus. So it's trying to sort of manage the fact that you've got massive skepticism now priced in general in terms of the earnings environment in China and people for a variety of reasons reducing their exposures. But we are not, we are not looking to be overweight. We're not. I don't want to give the wrong impression. We are. I would say it's cautious cautious optimism on a 1-3 year basis.
Thank you. We're out of time, but thank you so much for your questions. There's obviously, I think we could go for another hour on this topic. If you have other questions, please find your Barron representative, and we'll be happy to get back to you. Thank you again for attending our 30th annual conference, and we're off to the next session.